A stealthy shift in the labor market. The rise of quiet firing and its impact on investors in 2025. Market Pulse. Tuesday, August 12, 2025. 3:59 p.m. Eastern Time. 40-minute read. The labor market is undergoing a subtle but significant transformation, and investors need to be aware. In 2025, a growing number of employers, over half of U.S. companies, according to recent surveys, are employing a strategy known as quiet firing. This approach allows businesses to reduce their workforce without the usual formalities, costs, or reputational risks associated with traditional layoffs. But here's where it gets controversial. The methods used can have far-reaching consequences on workplace dynamics, employee morale, and long-term productivity. Understanding quiet firing, a covert cost-cutting tactic. Quiet firing isn't about outright dismissal. Common tactics include stifling career growth. Employees are suddenly denied promotions and development opportunities, signaling they are no longer valued. Financial neglect. Despite strong performance, raises and bonuses are withheld, diminishing the employee's perceived worth. Social exclusion. Being left out of meetings, projects, and communication channels isolates employees and makes them feel irrelevant. Unrealistic expectations. Impossible deadlines and frequent shifts in priorities create a sense of constant underperformance. These techniques are especially effective in a tight job market, where financial uncertainty and limited options can trap employees. For instance, 85% of companies using quiet firing report successful headcount reductions, but 90% acknowledge a significant drop in morale. The result is a workforce in survival mode, with high performers becoming disengaged and attrition rates quietly rising. Sheesh, industries leading the quiet firing trend. The sectors most actively adopting quiet firing are those facing intense economic pressures. 1. Technology. Giants like Microsoft, MSFT, and Intel, INTC are cutting thousands of roles through a combination of formal layoffs and quiet firing. Microsoft's 9,000 job reduction and Intel's 24,000 job cut reflect a broader shift toward AI-driven automation and cost optimization. 2. Financial services. Banks such as Morgan Stanley, MS, and Santander of UK are restructuring, with over 2,000 job cuts each. The sector's emphasis on automation and regulatory compliance makes quiet firing an appealing cost-cutting tool. 3. Retail and consumer goods. Companies like Walmart, WMT, and Procter & Gamble, PG, are streamlining operations, with PG eliminating 7,000 non-manufacturing roles. The rise of e-commerce and changing consumer habits are driving these changes. Shasha. The investor's perspective. Key areas to watch. As quiet firing becomes more common, investors should focus on 3 critical areas. 1. HR technology, the future of workforce management. Companies are investing heavily in tools to detect and mitigate the effects of quiet firing. Platforms like EmpMonitor and Workday are used to track employee engagement, workload balance, and communication patterns. Predictive analytics and AI-driven HR systems are gaining popularity, with 74% of companies planning to boost their HR tech budgets in 2025. AI and automation. Tools like HireVue and LinkedIn Learning are streamlining recruitment and training while minimizing bias. Employee experience platforms. Platforms such as Bamboo HR and Qualtrics, 2GEN, are centralizing employee interactions, from benefits management to mental health support. Blockchain for compliance. Secure, auditable records of employee data are crucial for legal compliance, especially in global operations. 2. Legal compliance and risk management. Quiet firing comes with legal risks, particularly in regions with stringent anti-discrimination laws. Companies are increasingly collaborating with legal tech firms to navigate complex labor regulations. For example, blockchain-based solutions like Estonia's X-Road are being adopted to ensure transparent and compliant employee data management. Investors should keep an eye on firms specializing in AI governance platforms, which help organizations avoid ethical issues in algorithmic decision-making. 3. Employee retention and wellness. As quiet firing erodes trust, companies are ramping up retention efforts. Investments in mental health platforms, e.g. Wellable, Headspace, and personalized wellness programs are on the rise. For instance, Toyota's One Toyota platform has reduced turnover by centralizing employee resources. Investors should also consider companies offering flexible work solutions, such as remote collaboration tools, e.g., Zoom, Slack, and AI-powered career development platforms. Risks and opportunities for investors. While quiet firing offers short-term cost savings, it poses long-term risks for companies. High-performing employees are more likely to leave, leading to a talent drain that can stifle innovation and growth. For example, Microsoft's stock price has fluctuated due to concerns over its workforce restructuring, reflecting investor skepticism about the long-term impact of such strategies. On the other hand, companies investing in HR technology and employee retention are positioning themselves for resilience. Workday's WDAY stock has outperformed the SP 500 in 2025, driven by demand for its cloud-based HR solutions. Similarly, Qualtrics QGen has seen strong growth as organizations prioritize employee sentiment analysis. Conclusion: navigating the quiet firing landscape. Quiet firing is reshaping workplace dynamics in 2025, with significant implications for employee morale, productivity, and corporate culture. For investors, the challenge is to balance the short-term allure of cost-cutting with the long-term risks of talent loss and reputational damage. The sectors most affected, tech, finance, and retail, offer both cautionary tales and opportunities. While companies like Microsoft and Intel face the fallout of aggressive restructuring, those investing in HR technology, legal compliance, and employee wellness are emerging as leaders in a rapidly evolving labor market. As the workforce continues to demand flexibility, transparency, and value, the companies that adapt will thrive. Investors who recognize this shift early and allocate capital to the right solutions will be well positioned to capitalize on the next phase of labor market innovation. What do you think about the ethics of quiet firing? Should companies be held accountable for these practices, or is it a necessary evil in today's economy? Share your thoughts in the comments.